HDFC Bank is not just another bank. It is one of the India's largest private sector financial giant, trusted by millions, followed by institutions, and watched by serious investors. Because when a company of this size slows down, it matters. This is not only a banking story. This is a wealth creation story because many investors make one dangerous mistake. They believe a great company automatically becomes great investment. That belief can cost years. A great company and great stock are not always the same thing. And if you do not understand that difference, you can trap your capital in slow compounding while better opportunities run away. So today we ask the real question. HDFC Bank is powerful business, but can it still create strong shareholder returns from here? Watch this till end because this is where real investing starts. First principle. A company can be trusted, dominant, profitable, disciplined, and still deliver average stock return if growth slows or valuation is too high. Reputation does not replace mathematics. Numbers decide returns. For a bank, the real engine of wealth creation are deposit growth, loan growth, net interest margin, profit growth, return on equity, and valuation multiple. When these rise together, wealth compounds. When they weaken together, return slows. Now, what changed? The biggest event was HDFC Limited merger. Overnight, the institution became even larger, but size alone does not create returns. The merged entity inherited a massive mortgage heavy loan book. Mortgages are high quality but usually lower yield than many other lending products. So the balance sheet became bigger but profitability mix come under pressure. And banks do not monetize size alone. They monetize spreads. Now look at the number. In recent quarters, deposit grew faster than loan. In one period, deposits grew around 15.8% year-on-year basis, while advances grew only around 5.4%. In another, deposit rose around 16.2%, while advances were only around 6.7%. That tells you management was prioritizing funding strength over aggressive loan expansion. That may be wise for long-term stability, but in the short term, it can suppress visible growth. Now, top line. For bank, the closest operating top line is net interest income plus fees and other income. Recent net interest income growth in multiple quarters was only around 2%, 4.6%, 5%, and 3.2%. For an average company, maybe that's acceptable. For a premium franchisee, the market notices instantly. Now, margins. HDFC Bank historically enjoyed premium profitability, but post-merger, net interest margin in a recent quarter was around 3.38%. Below near 4% level, many investors associated with the old franchisee strength. That may sound like a small decline. It is not. In banking, even 20 to 50 basis point, like zero point 0.2 to zero point 0.5 basis point can move earnings meaningfully across a giant balance sheet. Now microeconomics. Why is pressure visible? Because deposit composition across the banking system increase. When many banks fight for deposit, funding cost rise. If funding cost rise faster than lending yield, margin compress. That is very important to understand. That is a macro pressure. Then management must make micro decision. Chase growth aggressively, protect margin, strengthen liability first, defend asset quality. Those decisions shape future shareholder return. So should investor ignore slower growth because it is HDFC Bank? Absolutely not. Brand is not a substitute for numbers. You must ask, is the slowdown temporary or structural? Can loan growth recover? Can margin improve? Can return on equity rise? Is valuation fair? That is how analysts think. Now opportunity cost. If one company can compound earning at 18% and another at 10%, capital should care. Money stuck in slower compounding has a hidden cost, even if the business is excellent. That is why safe stock is not enough. Safety protects downside, growth creates upside. You must know which one you are buying. So what should investor track from here? That is very important to understand. Loan growth recovery, deposit quality, not just quantity, margin trend, return on equity, ROE, valuation discipline, because even a great business bought at wrong price can disappoint. Now the conclusion. HDFC Bank may remain a great institution, but the market is asking a sharper question. When does greatness convert back into growth? That answer decide whether this is dead money, patient money, or smart money. In part 2, we go deeper into the hardest question of all. Does HDFC Bank really need 15 to 20% growth to create wealth, or can lower growth still generate strong returns through valuation and profitability? Most investors misunderstand this completely.